G'day folks, welcome back to another update for gold and silver. Both instruments have been rising recently, but do look out for a divergence that's currently still in play. Make sure you hit that like and subscribe button to support the channel. Now looking at the outlook for both gold and silver, for gold prices are near record highs, currently around $2,900 per ounce, up 8.5% this year after a 30% gain in 2024. Key drivers include concerns over US tariffs on China, inflation fears and geopolitical uncertainties, prompting investors to seek safe haven assets. Central banks from emerging markets such as Poland, Turkey, India and China have been significant buyers, supporting the rally. Analysts suggest prices could surpass $3,000 per ounce due to ongoing risks. For silver, prices have risen 14% this year, currently trading around $31.55 per ounce. The metal benefits from its dual role as a safe haven asset and industrial component, with industrial demand expected to grow by 9% this year. That should be 2025. Driven by applications in electric vehicles and solar panels. The global silver market is forecast to remain in sizable deficit in 2025, marking the 5th consecutive year of shortfall. Analysts believe silver could outperform gold this year, with potential price targets about $35 per ounce. So first looking at the gold price, and we always look at the long-term trends first. It's the monthly, the weekly and the daily, and for those new to the channel, we've got these moving averages on both the price chart and also the CCI 150. Available in the description below for reference if you want to watch that video. Now notice on the monthly there is no CCI for it, but we'll just assume that it's in a very strong bullish momentum, obviously, well above its moving averages, and the price is still rising on the monthly. On the weekly, we do have a continuous rise, as I said, on the price chart, but notice the CCI is dropping off. Now we could draw a divergence here, and that brings it back to, we'll take it to the recent CCI reading, and the equivalent of that on the price chart goes up to there. Now, it may keep rising. So long as the CCI keeps falling and the price keeps rising, we consider that a bearish divergence. And we should start measuring Fibonacci once it breaks through below this moving average on the price chart, and that's probably where it's going to start retracing. But we expect to retrace at the very minimum. If I was to draw it from that high down to that low, at the very minimum we expect to retrace to that level there. Now it's a bit premature to measure it now because, as I said, it's still a strong uptick on the price chart, and as soon as we start getting a break below that moving average, then I'll redraw these Fibonacci's. I won't draw them now to avoid confusion, but basically that's where we are on the weekly. On the daily, we did have this resistance at 27.90. Now I'm going to remove that. It's actually broken through that, and also if I zoom out a bit, you'll notice we had a slight bearish divergence on the CCI there versus high highs in the price. Now since our last update, that has actually risen, and you'll notice now that's moving higher than that previous peak. So that no longer applies, so we're going to remove that and invalidate that divergence and also that trend line there. So no longer a divergence on that little period there. However, if you pulled it from that peak, that's still potentially a bearish divergence, and that'll be the equivalent from there to there. But again, similar to the weekly, I'm not going to draw a Fibonacci retrace on this one yet until we see a pullback a lot stronger. And these divergences, by the way, are different divergence on different time frames. Now if we go to the intraday chart, we only take reference to according to the daily. We trade in the direction of the daily. We trade on the hourly. I've got the hourly chart here. You can change this with your own intraday time period. So you can see here, starting back in 2nd of January, you would have taken long trades, and that goes back to this period here, and you would have taken long trades when the CCI was above the moving average, and so was the price. I'm not going to draw all those gains there, but you can see how that works. And more recently, for example, when that broke above the CCI there, you could have taken a long entry there. Let me just draw a measurement tool. So when it breaks above the CCI and the price chart, and you close it out, you could have closed out the first one there, that would have been a break even, or you would have closed out the second trade, or if you kept in the first trade, when that CCI breaks into the moving average band, so you would have closed it out there. That would have been a 1.24% gain in 22 hours of trade, and again this is on the hourly. So again, only trade in the direction of the daily if you're trading on the intraday time frame. Now at the moment, we did have this bearish divergence to that point, and I'm going to extend that to that more recent CCI reading, and that'll also extend that to there. So again, I'm not going to draw Fibonacci for it yet until we see this break below this moving average band. Theoretically, this was the first bearish divergence between that period and that period. Let me just redraw that. So you would have gone to that level there, and you would have taken to that level. So you can see there's a bearish divergence on the CCI versus higher highs in the price. And let's get rid of that. And the way you would have measured that, you can see there it pulled back and it retraced. And once you start seeing a break below the moving average, that's where you take it back to that recent low. You can see there it pulled back to the 61% level of that. I'll take it back to the recent low before that divergence started. So that was pulled back to the 61% level. At the minimum, it retraces, let me just try and draw this, between a 23 and a 38% level. So that's where it was back then, and since then it's actually, the price has rebounded. But you could theoretically draw that as a bearish divergence on a longer time frame there on the price and the CCI. So that's where we are at the moment. I'm taking long trades only in the direction of the daily, so that you can theoretically have taken a long position at the moment, current hour, if you're watching this, and go long. But again, be careful, we're in a bearish divergence. I don't trade these divergences. I use these as a potential area to avoid trading if I see a bearish divergence. You could have retraced at any one of these points, and you could start to retrace from there. So just be very cautious about going long because of this bearish divergence. Next, we're looking at silver. Now, on the monthly, you can see there it's also above its moving averages on the price chart, and likewise the CCI was very bullish. It pulled back to the CCI moving average range, and then the week after, or the month after, it started going bullish again. So bullish movement on the monthly. On the weekly, it's also bullish, well, on the price, but not bullish on the CCI. So if you're trading on the daily, avoid going long or short until we see a more decisive move above or below this moving average band on the CCI. And this is a response to this bearish divergence. And you can see there it's pulled back, and that was a minimum 23-38% retrace level. On the daily, again, it's hit this resistance at least once at 34.87. Looks like it may be coming back towards that level again. No guarantees, of course, so it will take it one step at a time. So on the daily, it's going long after hitting this minor support at 28.74. Now, if we go to the intraday charts, we only take long trades in support of the daily trend. So again, that started back in January 29, which is back in this period. January 29, so you would have taken your first long entry there. Just quickly draw a couple of trades here. So you can see there that first entry right above the CCI would have been that candle, the close of that candle, and you would have closed it out when the CCI touched that moving average band. And that would have returned 1.2% in 20 hours of trade. Enter another position there, the next hour, almost the next hour, and close it out again when it starts declining on that candle. So that would have been a 2.1% gain in 14 hours of trade. And since then, you would have avoided going long because of this bearish move on the price and the CCI. And you would have gone long again here when it broke above that candle. Maybe close it out on that because it touched that moving average band, and then re-enter it again from that point. And you would have got out again, very minor gain. So very minor gains there. Then another gain there again. That candle there. And you would have got out of the trade on that red candle there. So you can see there are a few little trades there, and that's the way you trade it. I avoid closing it out when it touches the moving average of the price band, because often you lose a lot more profitability on a bigger, steeper decline, as opposed to a very minor decline on the CCI. To support the channel more, hit that like and subscribe button and share the video. For added benefits and the cost of a coffee, consider subscribing to the Patreon page, where we look at weekly scans of bullish trending shares and insider trades that may have occurred. Thanks again, and see you in the next video.